Hello, successful and soon-to-be successful traders. Chris Capri here, secondsguysforex.com. Welcome to the first video in the trading risk and money management section. I really wanted to kind of expand and amplify your perspective on risk, your understanding of risk, how to understand your trading edge, your expectancy, trade frequency, risk of ruin, drawdowns, all these things. I really wanted to kind of take your understanding of risk to the next level so you really start to see things in a much more complete way. It's very easy with all the literature out there to look at risk in a very two-dimensional perspective of accuracy and risk to reward, but there's actually a lot more to that. And, to be honest, we could spend, a dozen videos really going down the rabbit hole to understand risk. The bottom line is that when we understand risk, money management, accuracy, all these things, when it comes down to trading performance, it really is down to mathematics. And that's one of the great things about it. It's super straightforward. The problem is that it's not exactly that sexy. It's not the most sexy part of the lessons. The videos, without a doubt, the videos that are going to be watched the most are the ones on the strategies, and the ones that are going to be watched the least are the ones on risk. That's just the way it goes. And that's really sad because a huge portion of your performance and profitability is locked up and tied and married to risk. And so most people give it, they really give it an underweight in terms of importance and performance, and it's something that you're going to need to buff up. You're going to need to become more adept at this. You're going to need to understand more. You're going to need to really amplify your study, understanding, and perspective on risk. And so that's what this section is about. Today's video is really about understanding your trading edge, expectancy, and trade frequency, and how this kind of ties into performance, how it all ties into profitability. And so this is kind of the base terms I want you to start with, and then we're going to kind of get into some more nuanced terms. By the time you're done with this section, you'll have a pretty advanced level of understanding of what risk and money management is about and how that will really determine whether you make money or not. So let's jump into this. When it comes to understanding profitability, we have to understand that profitability and performance operates on a spectrum. There are no, it's not a fixed thing where this is the only way to do it and this way is not. There are varying degrees of profitability and performance that can have so many permutations. There are virtually an infinite amount of permutations in terms of trading performance. And if we look at this, this is kind of a basic diagram, and this doesn't even say the whole picture. But if we look at just accuracy and plus R per trade has to do with if I am risking $1,000 and I'm consistently targeting $2,000, then my plus R per trade is 2R. It's 2 times my risk. R is the risk. So I'd be getting, if I hit my take profit of $2,000 on this one here, then I've gotten plus 2R on that trade. Generally what you see is there are certain patterns for sure, and then there's kind of like a mean or baseline or kind of a general range of profitability that works out really well. When it comes to accuracy, the area that you have to absolutely avoid is the low accuracy and low plus R per trade. And what do I mean by low plus R per trade? I'm talking about 1 R or less. Your winners tend to be, at best case scenario, the same size as your losses, but oftentimes are slightly below or less than the size of your losses. This is an area you're going to have to absolutely avoid as much as possible if you really want to make it. If you look at the majority of professional and institutional traders, if you were to plot little dots on where they are, they aren't here. When we look at the other end of the spectrum, the other kind of polarity, the high accuracy, 60, 70, 80, 90%, and high plus R trades, these strategies are rare and virtually non-existent. It's very rare that you're going to find something that is 60% accurate and getting 2R, 3R, 4R, 5R consistently. Those systems are super rare. And what you most commonly see is that there is kind of a mid-range of accuracy. And amongst the institutional world, from what I see on my end of the accuracy, it's anywhere from 30 to about 50% accuracy. 50 would be higher in terms of institutional FX traders. That would be on the high end. But generally you see them between the 30 and 50% range. That's kind of the mid-range. And in terms of the plus R, what I consistently see is I never see any institutional traders targeting less than 1R. The majority of them are targeting on the very low end 1.5, more common is 2, within a general band of commonality is 2.5. But I also see a lot of FX traders targeting 3, 3.5, 4, 5R, maybe even higher. If I had to kind of place them on the spectrum, I would generally see them more around here in terms of plus R per trade and in terms of accuracy. So they'd be kind of this section. They tend to cluster around this area. Very few institutional traders that I see go for high accuracy and low profitability. The clustering seems to be right around here and working their way up here. But the bottom line is that there is a wide spectrum of profitability. There is no fixed number. There is no formula that you should be following. I generally recommend targeting nothing less than 1.5R per trade. And to me, that would be on the low end of the spectrum. 2R, I probably 2 and 2.5R, I probably consider that mid-range. And 3, I would consider that skillful. I would consider that a pretty darn skillful trader who can consistently get 3R per trade. Now, obviously, accuracy matters. You can get 3R per trade, but have very low accuracy, and so that means no profitability. This is what you're targeting, and you have to understand that the main message that's being communicated by this is that there is a huge spectrum of profitability, and there is no one formula for that. The other thing is that you will also operate in flux. Unless you're trading a purely mechanical system that has like fixed take profit and fixed plus R per trade and has a relatively stable accuracy, you're going to operate on a spectrum and a continuum, and it's going to adjust. It's going to be nebulous. It's not going to be perfectly succinct all the way through. So it's going to be in flux, and you have to understand that. The key is that you stay within this kind of range and barometer of profitability. You do that, you're going to make money. Now, the first term I want to get into is how to calculate trade expectancy. This is something that's very important to know. So expectancy is based upon two simple variables. One, it's based upon accuracy, and two, it's based on your plus R per trade. When I say accuracy, I mean your percent accuracy. Are you 35% accurate on average, 40%, 50%, 60%, whatever? And then your plus R per trade. Are you targeting consistently 1R, 2R, 3R, 4R, 5R? There is a formula for expectancy so you can understand your expectancy, because your expectancy is going to give you a window into your edge. And the formula is this. It's your percent winners times your dollar per winner minus your percent losses times your dollar per loss. That number will equal X, and you take X and divide it by number of trades. So let's go into do a walkthrough of this formula. Let's say we have a system that is 35% accurate, and it's averaging $1,000 per trade. And that means we have 65% of our trades are going to be losses, and we're averaging $400 per loss. So it's a plus 2.5R per trade. It's a very respectable, profitable system. This would be quite the norm in an institutional fund firm, anything. This would be totally respectable, totally normal. In fact, this would probably be this would probably be right around the norm. What that basically means is that you're making $35,000 over a series of 100 trades. You've made $35,000. You've won 35 trades at 1,000. That means you made $35,000. You lost $26,000. And what that means is your total profitability is $9,000 over a series of 100 trades. Now, expectancy, if you look at the formula, whatever that number is, we divide it by the number of trades. 9,000 divided by 100 trades equals a $90, positive $90 expectancy. Now, if you have any number that is positive, you're making money. Your system makes money. Over 1 year, 2 year, 3 year, 5 years, you're making money. You may have some drawdowns, you may have some months that or quarters that you're going to lose. The end of the year, over a long enough series of trades, you're profitable. You don't have to do a damn thing to change that system. Obviously, the higher the expectancy is, the more profitable you are. Now, to be honest, plus 90 expectancy is a very high expectancy in this case. It's very strong. Generally, what I see across, institutional traders and myself is anywhere from the, 20, 25, 30, 35. That's generally what I see in terms of expectancy. The great thing is that you can tell me the basic formula for this and your expectancy, and I can tell you immediately. I can tell immediately, do you have a profitable system or not? Anything that is positive equals an edge in profitability. Your goal should be first to develop a positive expectancy. Neutral or zero means you're break even. The great thing about that is that you're literally just 1 or 2 adjustments from breaking into positive expectancy. If you're negative, then you got more adjustments to make. So your goal should be positive expectancy. Now, to further elaborate this, I want to kind of start getting into another aspect or variable in understanding and broadening your perspective on understanding risk, money management, performance. That has to do with expectancy and trade frequency. Now, we're going to use 4 strategies as examples here. So the baseline for this study is you're risking 1% per trade. This is over a series of 100 trades. Plus 1R equals $100 per trade. And the RR, risk of ruin, equals 0. We'll get into risk of ruin in the next lesson, but for those of you who have read my articles on it, risk of ruin it actually came out of gambling. It's a mathematical concept that's going to determine whether you're going to blow up your account or not. If you have a risk of ruin of 0, you have a 0% probability you're going to blow up your account. That means you're going to make money. That means you have some sort of edge. How much? That we need other variables to determine that. So let's look at 4 different strategies that you can kind of choose, or you just kind of give you a broad perspective of how performance and profitability is determined by expectancy and trade frequency. So if we have a standard day trading strategy, you're about, maybe you're 60% accurate, maybe even a little less. But let's say, a relatively higher frequency strategy. Generally, the higher accuracy, the lower profitability trade. So this one is plus 1R per trade. You risk $100, you lose $100, you're 60% accurate, you're going to make money. The next strategy is kind of like a shorter term swing trading strategy. Maybe you hold trades for a few days. It could be active, it could be in and out in a day, but generally you hold the trades for a few days, maybe a couple weeks at best. This would be kind of similar towards my strategy. And so you're averaging about plus 2R per trade. Let's go for a longer term, higher plus R swing trading strategy that is 30% accurate and that is averaging plus 3.75 R per trade. So for every $100 they're risking, they're gaining 375 per trade. That is a very, it's not only a highly profitable strategy, but the ability to capture plus 3.75 R consistently 3 out of every 10 times, that is what I would consider a higher skill trader. The ability to capture more R per trade while still maintaining profitability shows an increased level of skill. And we'll talk about why that matters later on. The next strategy is someone who is a super high frequency day trader. They are 90% accurate, but they're getting 0.15 R per trade. What that means is that they're winning 9 out of 10. And so they're losing, for every $100 that they lose, they gain 15. This actually has profitability. So, this is kind of like the extreme end of the equation. Now, when we do the formula for expectancy, what it ends up coming out to is strategy 1 has a $20 expectancy, or 0.2. And so that when we do expectancy, you do it in dollars, but you always divide that by, say, 100. In this case, it would be 100. So in this case, $20 divided by 100 would be 0.2, basically. So, or 2 out of 10 is the way we do it, basically. So the next strategy right here has an expectancy, a positive expectancy of $35, or 0.35. This low accuracy, high plus R system has an expectancy of $47, or 0.47. So the highest expectancy of all of them. And then the last one has $3.5, or 0.035. Now, in and of itself, if we are assuming everybody is taking the same amount of trades, strategy number 3 has the highest expectancy. If every single one of these strategies is taking 100 trades per year, strategy 3 wins. It makes the most money. This makes the most, second most, third most, and the least amount. So this is the best way to go. However, when we start to factor in trade frequency, we start to see how the equation is much more nebulous, and that changes things. So now let's look at this case study a little bit more deeply. If we look at high versus low trade frequency, our strategy 1 that has the +1R per trade and 60% accurate, this is someone who's a little more active. It's probably a day trader of some sort. Maybe they're taking on average 2-3 trades a day. So let's assume they have 500 trades at the end of the year. This would be someone who's pretty active. They're not super active, but they're highly active. They're not someone who's doing 3, 10, 15 trades a day. The next one is averaging about 1 trade a day. There's generally about 225 trading days a year, if I remember correctly. So this person's averaging 1 trade a day. And that also means that they probably have several rolling swing positions on any given week. So they're still pretty accurate, or they're still pretty free. They're still pretty active, but they're doing a little less than half the trades. This person right here is kind of the longer term swing trader. They're holding trades for weeks, maybe a couple months, and they're looking for big wins. And so because of that, it takes a little bit longer for those wins to materialize. So they're trading less active, but they're still pretty active. They're having, an average of a little over 3 trades per week. And then we have our super high accuracy, super low profit, high frequency trader doing 1,200 trades a year. Now, when we plug in the accuracy or the expectancy for each one of those, what we see is that even though strategy 3, assuming all things are being equal at 100 trades, had the highest expectancy and therefore profitability, when we start looking at how trade frequency goes into the equation, this is where the profitability goes to. Strategy number 1 makes the most money. Strategy number 3, which had the highest expectancy, now falls into 3rd place. Strategy number 2, a little more active, a little less profitability, is in 2nd place in terms of profitability. And our higher frequency strategy makes the least amount of money per year. What this goes to show is frequency matters. This is something that all poker players understand very clearly, especially if you're playing online poker. If you're playing online poker, you are playing multiple tables at a time. You're very rarely playing one table at a time. And the reason for this is because you're not paid per hour. You're paid per how many hands. The general stat is plus BB over 100. How many big blinds are you winning over 100 hands? Now, assuming you can do 100 hands per table per hour, which is high, it's generally around 60 to 70, but let's assume 100 per hour. If I'm making, 2 or 3 big blinds per 100 per table, well, the more tables I can play, the more profitable I will be for that hour of my time. That's why online poker players build into trading multiple tables at a time. When I first started, I could only do 1 table at a time. Built it up to 2, 3. Now I'm doing 4 at a time, and I can pretty much keep my concentration and focus solid for a good 1-2 hour period. straight, no interruptions, nothing like that. I can manage doing 4 tables at a time. And so that's because a lot of the decisions I'm making now are subconscious. They're automated. I know exactly how I want to act in each, situation. Pre-flop, post-flop, I still have a little bit more to learn, but even that's becoming subconscious. So poker players understand this. For some reason, it hasn't fully made it through the consciousness in terms of traders, probably because there's a lot of narratives out there that are kind of really spreading a lot of confusion about it. But the bottom line is, look, if I know with this system that I can make, on average per pair, I can make, whatever, $10,000 per year at the end of the year per pair. If I can replicate this across other pairs and I'm making the same amount of trades per pair per day, well, then the more instruments and the more trades I'm making will increase my trade frequency and therefore edge and profitability. This is super important. This communicates something to us. So we have to really understand a crucial lesson out of this, which is that really performance and profitability is dependent upon many variables. Your edge is dependent upon your expectancy, and your expectancy is dependent upon your accuracy and plus R per trade. But also, what determines profitability is your trade frequency. These two together, expectancy and trade frequency, is what determines your profitability. Now, the thing about it is there is no set formula for this. There is no equation. There is no cut and paste thing that you're supposed to follow. The key thing is that you understand that this works on a sliding scale. This works on a spectrum. And there are millions of ways that you can become profitable and have a profitable trading edge. You have to understand how all these variables relate to each other. How do they intermingle? How do they affect each other? We know accuracy and plus R per trade has a huge factor and weight upon our expectancy. We also understand that trade frequency matters. The strategy which had the highest expectancy, when we start to factor in trade frequency, actually make less money per year. So we have to look at all these different variables. You might not be the person who wants to be highly active. You might want to be that swing trader who holds not as many positions per year and just gets plus higher per trade. We'll talk about the advantages and disadvantages of that system in some of the upcoming videos, especially when we talk about durability. You might want to be a person that shoots for higher accuracy and makes less money per trade. A note, kind of a note of caution or insight about that. Generally, when I see students looking to find the highest accuracy system, there's a reason for that. It's because inside their mindset, there is a lack of confidence and ability to tolerate losses. So they're looking for high accuracy systems to leverage their lack of confidence and their ability to tolerate losses. So they're kind of looking for these things as a crutch. There's nothing wrong with that, but just understand, as long as you have a crutch to walk or make something happen, you're dependent upon that. Your goal should be eventually to be able to tolerate losses, to have confidence that if you have some losses or a drawdown, that you can make that up. Generally, I find that people that consistently look for high accuracy systems don't have that confidence, don't have that tolerance for losses, and when the losing streak does come, and guess what? Hint, it's going to come. When it does come, those are the people that struggle the most to get back on the horse, to execute mentally the way they need to. So we'll talk about that a little bit later and why certain systems are more consistently sought out by professionals. I do remember a conversation, I think it was in Market Wizards, where they were talking to one of the market wizards, and they said, there's this study done where they interviewed some of the top traders in the world, and they said, if you could have a 70% system, a system that's 70% accurate and gains, +1 R per trade, or a system that's 30% accurate and gains 3.5 or 4 R per trade, which system would you take? And the overwhelming majority of them said the 30% accurate system. I want you to think about why that is, because we will get into this in the lesson on durability. But just understand that you can operate in many different ways inside this spectrum. You have to understand how they all affect each other, relate to each other, and kind of change the dynamics of the profitability for your trading. The good thing is now that you are aware of this, you can see things in a much more three-dimensional perspective. It's not this kind of flat world where it just has to do with accuracy and risk to reward. That's for beginners. We didn't even focus on the last one. We started talking about risk of ruin. We started looking at things in more three-dimensional ways. But I wanted to really kind of unfold and unpack this a little bit further. You can't go back to seeing things in a very flat two-dimensional way. You have to see this as a three-dimensional model for approaching risk and understanding how this affects your performance. So with that, I hope you enjoyed this video. I really hope that it changed your perspective on how you look at risk, performance, and profitability, and that you're starting to kind of see things in a different way. I'm also hoping that this provokes you to really look at what feels most natural to you and start really getting into the numbers and digging into them, with your trading methodology. You're going to want to understand each of these individual components, as separate units, and then see how they all affect the whole. And once you start to move the pieces of the puzzle, you can see how these are really affecting performance and profitability, and it gives you much more flexibility and fluidity to be able to manage the situation and find a kind of central point that is natural for you to rest upon, because there is somewhere in that spectrum that is very natural for your psychology, your dispositions, your strengths and weaknesses. And when you start to work on each one individually, you start to see how you can really eliminate areas that are causing your performance to, causing you to underperform, and really start to lift up your performance on multiple ways and multiple levels. So I look forward to your comments and questions on this, and I'm expecting a very good, vigorous discussion on this. There's going to be more videos in here, some really important stuff, but this should give you a very different perspective on risk, money management, performance, and profitability. So I'll look forward to your comments and questions on this, and until then, I will see you inside the course.